Hey guys, Toby Mathis here, and today I want to go over something that was actually written on a golden snitch in Harry Potter, but it's something that was said during the movies. You may recall he had a golden snitch that said, "I open at the close." And that term was when Harry was close to the end of his life. And if you know the movie, I'm not going to spoil it for you, but then would open up and there's this resurrection stone sitting inside, or whatever it was. Immaterial. What I liked about it was it set me off thinking on business planning, because realistically, when you're setting something up that's going to create a legacy, it does kind of open at the close, right? You're in charge of it during your lifetime, and it takes on a life of itself once you are gone. And I don't want to get too philosophical about it, but that's essentially what it all comes down to, is when you're setting up a business, you should be thinking about the end of your involvement with that business and what's going to happen with it going forward. Hey guys, if you could do this for me real quick, if you could like this, I will bribe you with pictures of my cats. Like this video, subscribe, and even click that little bell so that you get notified when new videos come out. So I was on a podcast earlier today, and I was talking with another attorney, and it was a podcast with an attorney for attorneys. One of the things we were talking about was business planning. Whenever you're setting up a business, and I always say, well, it really depends on what you want to accomplish when you're setting up that business as to what it will look like when you set it up. So for example, if I am setting up a business that I know is going to be very valuable, my intent is to sell it in 5 to 10 years. There are specific tax statutes that allow you to avoid all the capital gain on that if you do it. It's a 1202. So, and that will dictate what type of business. It has to be a domestic C corporation, for example. Then all of a sudden you get some benefits. Or, hey, I'm creating something that is going to be a family legacy. Hey, I want to create a restaurant. Or, hey, I want to create a real estate company. Or, hey, I just want to manage and have a family corporation that we use to manage all of our assets. That is really critical when you are deciding what type of business you actually want to be. So it was kind of a fun conversation. I don't get to geek out with lawyers that often on topics like this, other than with our guys. This was somebody from another firm, and it was just really interesting because our philosophies aligned. And we were both kind of doing this whole thing of like, when you start setting up a business, you really should start by thinking of the individual and what they're creating and what kind of legacy they're creating. So it always comes down to the same thing, which is we cannot think of a single circumstance where somebody is a business owner where you don't have a trust involved. You should have everybody should have some sort of living trust, because otherwise you're killing that business. You're not giving it a chance to survive after you. And I don't just say after you, it could be while you're alive. If something happens to you, like one thing that this COVID pandemic taught us is that sometimes we get taken out for a little while. We had folks that were in the hospital for a number of months, and they still had their businesses and they still had to operate. And unless they had the correct type of business with the appropriate documentation in place, some of these people, they had their business destroyed. So you want to allow for other people to act on your behalf. In order to do that, the business kind of has to be its own creature, has to be its own person. And I say that person very deliberately because that's actually what it is. Even though it's a corporation or an LLC or a limited partnership or a limited liability, limited partnership, whatever it may be, that's an artificial person. The courts recognize it. It can contract on its behalf. It even has some rights under the Constitution. But it is actually separate from you. Otherwise, something happens to you, it happens to your business. And the way I look at this, or if something happens to the business, it happens to you. So if you are running your business, let's say you're a plumber and you make a mistake and you flood somebody's house and there's insurance coverage, but they're going after you too. They're going to try to exceed that policy and they're going to try to get to your personal assets. You're on the hook if you're operating as a sole proprietor. You are not on the hook if the business is separated from you as an individual and it's operating on its own and the individual knows that they're dealing with a business. So for example, if it's ABC Plumbing, you come in, you make a mistake, there's a flood, they're going after ABC Plumbing. You're not personally liable under those circumstances. Same thing with most liabilities of a business. You have a breach of contract. Unless you're a guarantor, the business is responsible. Same thing as if that business has a hardship, it gets shut down, The pandemic affects it, supply chain issues cause it to fail, or just bad business practices cause it to fail. You need to be able to walk away from that and not have it affect you individually, where it crawls over into your personal life and exposes all your other assets. So if I'm a sole proprietor and I'm operating that plumbing business, I'm personally on the hook if I have liabilities of that business, and vice versa. I'm the sole proprietor. Let's say that instead of you being the party that does anything, let's say it's one of your kids gets into a car accident, exceeds policy. This happens all the time, by the way. It's usually when there's a severe accident. And all of a sudden they're looking at you. Guess what? You and your business are the same. You are no different if you have not isolated it. So going back to the Harry Potter thing, begins at the end. When we're looking at whether you're going to be able to pass that on, it becomes it's not even a question. We will never be a sole proprietor if we're passing that on. If it's going to survive past our death, we have to create a vehicle. We absolutely 100% have to create some sort of entity to hold that. When you set up an entity, there's really three things I look at. Number one, I look at the state, what type of entities are available. I look at the tax ramifications of it, and I look at what's its purpose and how it's interacting with third parties. So I'll use an example that if, let's say I have real estate. Okay, so let's say it's rental real estate. That's my activity. All right, from a tax perspective, I really want it to flow onto my personal return. So it's going to be either disregarded or a partnership. I know that if I elect partnership status, it's going to go on page 2 of my Schedule E. And from a lending standpoint, that is better than if it flows onto my page 1. From a lending standpoint, for underwriting purposes, they can use 100% of the income on a page 2 if you're page 2 of your Schedule E, as opposed to if it was just disregarded. So there's these little nuances, right? But I want to separate that business out, that piece of property out. So I'm probably going to go with an LLC under those circumstances. And let's say that I'm not looking at a portfolio loan, that I want this to really be a closely held, it's all about me company, and I'm going to put a box around it. And the reason I'm going to put a box around it is because if anything happens on that property, I want it to stay in that property. So if I have a really horrific tenant, or if I have a fire, or I have something that occurs on that property, the most they can get is that property. But they can't take my other businesses, nor can they take my personal assets. They can't go raid my personal checking account if something happens on that property. I've isolated it. It's a person. Who's the owner of that property? The LLC, not me. What if I die? The LLC still owns it. It's much easier to transfer that LLC, and I would recommend everybody, again, I talked with another attorney, but I would recommend everybody use a living trust to avoid probate and having to go to court over these things. It's automatic. Boom. Have the LLC in the living trust. I pass the living trust, or I'm disabled. The living trust steps in and says, aha, here's somebody who can act on behalf of this entity. Here's somebody who can act on behalf of Toby, if it's my entity. I cannot do that when it's just a sole proprietorship. Everything flows into my personal, everything in my personal flows under the business. By putting an LLC around a business, at least I am isolating the liability of that business and keeping it separate from me and keeping me separate from that business. Now, there are circumstances where somebody can, if they're collecting on a judgment that I have against me individually, where they'll try to foreclose on those business interests. And that's where we start looking at jurisdiction. If you've watched our videos, if you've watched my partner's video, Clint Coons, if you've been to our courses, you know that we are very bullish on Wyoming and Nevada because they can never take your entity away. The most that they can ever take is they can get a charging order against your interest of your company, and they're standing there and hoping that you give them a handout. But they cannot force the sale, they can't foreclose on that interest, and they can't get your other assets. That's very effective when you're settling any sort of lawsuit or you're trying to minimize liability. It prevents it from happening. We use anonymity too. So we have a lot of security through obscurity. People can't see it, so they don't know it's there. But just if you had that lights out, bad lawsuit, and you end up with a judgment against you, and they're really collecting, and they're going to supplemental proceedings, and they're looking for your assets, it's nice to be able to say, hey, you're never going to be able to foreclose on that. Even if you get a charging order against it, even if you go through that expense, you're not going to get anything. I'm not going to give it to you. That creates isolation of the asset from you, and you from the asset, or from the business and you from the business. We call that, there's inside liability and outside liability. Inside liability is what the asset creates or what the business creates as far as liability. Outside liability is what you create and somebody trying to take the business from you. So there's outside the business liability, i.e. its members or its shareholders or you. And then there's the actual business itself. Why do I bring all this stuff up? Why are we even interested in this? It's because when I'm creating a business, I have to think, where are we going? If I am setting up a business, for example, on real estate, and I want the depreciation, and I have other real estate, I need to make sure that it's a specific type of business. It's not going to be an S Corp or a C Corp, I'll tell you that. It's going to be a partnership or disregarded. If I am setting up a business where my intent is, hey, in the first year, I might have some losses. Hey, I'm really concerned that I'm going to have some flow through losses, and I want to be able to take them individually. Let's say I'm opening up a pizza company and I'm buying a bunch of equipment, a big pizza oven or whatever, and I'm going to write that puppy off, and I want to be able to take that loss. Well, that tells me what type of entity I'm going to be. If I want that loss, I'm going to either be a disregarded entity, a partnership, or an S Corp. I'm not going to be a C Corp under those circumstances. Flip it around and you say, hey, I want to build value in this company. It's going to be worth a lot of money. Like I'm building up the intellectual property. We're coming out with a software as a solution. I'm going to have this valuation, and I know that when I sell this thing, it's going to be 7 figures, 8 figures, 9 figures, whatever it's going to be. And I want to make sure that I don't pay a ton of tax when I sell it. Maybe I can avoid 100% of that tax using a 1202 deduction. That tells us it has to be a domestic C Corp. You go in to see an accountant, though, what are they going to tell you? 9 times out of 10, they're going to say an LLC taxes an S Corp when they hear business. Or the vast majority of people are set up as a sole proprietorship. It's actually about 70% of all the businesses out there are sole proprietors. You just nixed your ability to do that. That's why you look and say, what's the intent over time? Hey, I want to create a legacy for my family. Okay, sole proprietor's off the table. Done. Has to be an LLC, corporation, C corporation, maybe a limited partnership, maybe a limited liability partnership, limited liability, limited partnership. Like there's different flavors depending on your type of your business you're in, what type of licensing you have. But for the most part, it really comes down to a simple choice, LLC or corp. LLC taxed as a corp, corporation taxed as an S Corp, C Corp, possibly, depending on what you're doing, even a nonprofit. And you're looking and saying, what is your intent with that business? So I'll go back again. Let's say that we're developing, hey, I'll do the plumbing company. Hey, I'm going to set up a plumbing company. Here's what I'm doing. Hey, do you need to take the money out? Are you going to be taking distributions? How much do you intend to make? Do you have other sources of income? Hey, yeah, my spouse is a surgeon and makes a ton of money. Okay, maybe we want to say, hey, you know what? At a minimum, let's just keep it off of you for now. Hey, my spouse is a surgeon. She's going to retire in 5 years, or we're getting close. I'm starting this business up. It's going to be okay, but I'm really just setting it up because I'm bored. Okay, then we might want to set it up as a C Corp, do it over here, keep as much of that income off of your return as possible, since you're not living off it. Hey, I want to do this, but I need to live off of it. Okay. Then we're just doing a comparison. If I was going to just take all the money, like, hey, your accountant says, oh, just be a sole proprietor. Then I'm looking at it saying, all right, number one, sole proprietors out the door, right? Just a straight out sole proprietor. But we could be an LLC that's disregarded for tax purposes. Now let's say, hey, it's making $100,000 a year. I'm going to live off of that. Sole proprietor versus a S Corp, you might save $10,000 a year by setting up an S Corp just on self-employment tax, just by taking a small salary. Plus you get the accountable plan. And if you don't know an accountable plan, watch some of the videos. It's huge tax benefits that are not available to sole proprietorships. Plus, sole proprietorships are audited, many cases at $100,000. You're probably looking at about 1,600% higher than an S Corp as far as the audit rate. It's astronomically higher, and sole proprietors lose 94 to 95% of their audits. Why? It's because the accountants always say, oh, the less formalities and you don't have to do anything. And we just open it up, operate your business. Unfortunately, that's not accurate. All businesses have to keep the same type of books and records and keep a record of their income and their expenses. And you still have the same requirements. It doesn't matter whether it's an S Corp, C Corp, LLC taxes, an S Corp, LLC taxes, a C Corp, disregarded LLC, sole proprietor, does not matter. Business trust does not matter. You still have the same record keeping requirements with the IRS. They do not care what it is. They're going to say these are the records you have to keep. So what happens? These people think that it's relaxed on a sole proprietorship. Oh, it's so much easier. You don't have to do all this. You could have the same bank account, blah, blah, blah. You're going to lose that audit on 95% of the time. And the reason being is because you're not operating as a separate person. You're operating as you. So the IRS correctly says, hey, it's you. We're not going to give you those deductions. The rules are different for a sole proprietorship than an S Corp, where you're an employee of the organization. You're an employee of the organization, all of a sudden you have accountable plans unlocked for you. And you can do everything from 100% reimbursements to things like cell phones, data, even a portion of your house, 280A, all these things get opened up for you where you're going to get a lot of other deductions. So when you're just looking at it as a comparison, all right, we're setting up our company, we're making $100,000. If you do it this way, you're going to pay too much in tax, you're going to get audited a lot. The least we could do is isolate that liability. Then we look at the tax and we say that's not even close. You should be an S Corp or a C Corp. Do you need the money? Yes, then let's probably be an S Corp. I don't need the money, or I have other deductions that I might be able to use. Maybe I can make this a multi-purpose entity. I'm going to do 2 or 3 things inside that business. It's going to be my family corporation. Great. Then it might be a C Corp. Hey, I'm setting up a business that we're going to sell and we're going to shoot for 10 years. We're going to develop all this stuff. I don't want it in my family. I'm not creating a legacy. This is something I'm literally just setting up to build value and sell. Okay, then we're probably going to be a C Corp. We're going to look at 1202 real close. Or, hey, it's a speculative business. I don't know whether it's going to make money. I'm going to put some money into it. Do you need the loss? No, I'm just going to put money into it. Great. Maybe we're going to be a C Corp and we're looking for 1244 stock loss ability. All those things come into play, and we have to know what the end is. If you're creating a legacy with your entity, hey, I'm creating a family company, making a family corporation, it becomes really, really small. We need a trust as a vehicle at a minimum. Period. End of story. Everybody needs a trust. If you're going to be a business owner and you're creating a legacy, you don't get to use the will, because wills die and distribute. It's not going to be the vehicle that you need. You want to create something that's going to be generational, you're going with the trust. Everybody has different names for it. You know, living trust, dynasty trust, all this, you know, they're different terms for the same thing. It's a trust. Don't complicate it. It's grantor trust, period. It becomes irrevocable once you die. Don't make it any more complicated than that. Hey, it's going to last, 200-300 years. Fantastic. Then that's what we're going to do. There's not another vehicle. It really comes down to just one. It's going to hold the business. What type of business? It depends on the activity. Hey, if I'm real estate, I might be doing something different than if I'm a real estate agent even, I might be doing something different than if I'm a mortgage broker, which I might be doing something if I am investing or running an Airbnb. All of those activities have different nuances. And if anybody tells you, oh, this is what you do with all of them, that's, fire that person. It's facts and circumstances, and a lot of it has to do with what your intent is over a long period of time. Begins at the end. We got to be thinking about the end to determine what we're going to do in the very beginning. Follow that advice. You'll be very, very happy. You'll be able to take advantage of things that other people don't realize even exist. You'll be able to avoid liabilities that you didn't anticipate that actually are real. And you'll be able to create a legacy if that's what you want, or you'll be able to find an appropriate vehicle to have an exit that does not tax you if you want. It all depends on what your intent is and what you're creating. It begins at the end.